आपकी डबल दिवाली का काम मैं करने वाला हूं। इस दिवाली में आपको एक बहुत बड़ा तोहफा देशवासियों को मिलने वाला है। हम नेक्स्ट जनरेशन जीएसटी रिफॉर्म्स लेकर के आ रहे हैं। ये दिवाली के अंदर आपके लिए तोहफा बन जाएंगे। सामान्य मानवीय की जरूरतों के टैक्स भारी मात्रा में कम कर दिए जाएंगे।
Hello everyone. Goods and Service Tax, when introduced in 2017, was meant to simplify India's indirect taxation. But with so many slabs of tax and GST cess, the system is still not yet simplified in the manner in which it was proposed to be. Now the government is proposing a major rationalization of GST rates and few exemptions in some services. In this video, we will discuss what is being proposed, why it is happening, how it impacts the consumer's pocket, and what challenges lie ahead. For sure, consumers are now holding back purchases, waiting for the GST notification, just like they wait for the Flipkart's Big Billion Day or Amazon's Great Indian Festival Sale. Just like the festival mega sales, the GST Council's decision is being seen as the next big discount season for India's shoppers. First, we will start with knowing the current GST structure. Currently, the GST has majorly four slabs which cover almost all of the items: 5%, 12%, 18%, and 28%, along with cess on luxury and sin goods. You can see in the table for so many different items taxed at different rates. Obviously, this creates classification disputes, confusion in the businesses for meeting the compliance and paying the taxes, and for the consumers as well. Next, we can also see the rates applicable for the bikes and cars as shown. The petrol cars below 1200 cc and the diesel cars below 1500 cc, which are considered as the small cars under GST, are also taxed at par with the high end cars, and the rate applicable is 28%, the base rate. For the bikes, also, the case is quite similar. As we can see in the table, there is hardly 3% difference on account of cess on the bikes, even like Splendor, which is of 100 cc, or take it Royal Enfield, the GT 650, such an expensive bike, taxed at 28% slab rate. So why is GST rationalization needed now? You obviously know, based on this discussion, the reason. We can summarize this in mainly four critical points. First one is obviously for simplification. Fewer slabs of tax mean fewer disputes and fewer confusion, leading to better GST compliances and correct tax payment, which the government expect business to pay. Second, boosting the consumer demand. High GST discourages purchases, even purchasing small cars below 1200 cc or bike with less than 100 cc, and electronic appliances, and lowering the taxes and makes them affordable and accessible to everyone. Third is supporting the middle class. Most consumer durables, even which has become basic necessity of life, like bike, small cars, medical insurance, health insurance, life insurance, ACs, which are currently taxed at 18% and 28%. Fourth point, encouraging the compliance. Fair rates might reduce tax evasion and broaden the tax base, which the government expect to happen, and which will obviously offset the tax revenue loss on account of these all rate reductions and the exemptions proposed. Now we will see what is actually being proposed in the notification that is about to come. Group of ministers has proposed scrapping the 12% and 28% slabs. India may move to a two slab indirect tax system: 5% for the essential goods and 18% for most of the goods and services. A new 40% rate is being planned for the luxury and the sin goods like premium cars and tobacco. Almost 99% of the items in 12% category will move to 5%, and 90% of the items which is currently taxed at 28% will move to 18%. Only the premium and sin goods will move to 40%. There's also a proposal to exempt the individual health and life insurance premium from the GST, which could have which could save households thousands every year. The timeline for this rationalization is expected to be completed by GST Council when they will meet on September 3 or 4, 2025 to decide on these recommendations. If approved, reforms could be rolled out as a Diwali gift, making essentials cheaper and simplifying taxes. Now we will see what are the challenges ahead. As we know that the road ahead is not easy, there are few challenges ahead. First one is the revenue loss. Moving goods from 28% to 18% reduces the tax collections and states are worried. The government is expected to lose about 85,000 crore annually. Yes, 85,000 crore. Second is fiscal risk. If the tax base would not increase as expected in the proposal, then this could widen the fiscal deficit as the government has to take hit in its pocket and has to make balance by finding the alternative source of income. Or it may lead to increase in inflation in the short term as the demand will rise, but the supply may not rise in that pace, leading to increase in the prices of the goods. Third is state resistance. States like Punjab, Kerala, Chhattisgarh are still waiting pending GST compensation dues. The center's promise to cover the revenue losses for 5 years was hit badly during the COVID as collections collapsed. Now, the states fear further rate cuts will shrink the revenues again, making them more dependent on the center. Fourth is the historical lessons and trend. We have seen this history before that in 2017 or 18, the GST Council slashed the rates on many items to please the consumers. This caused revenues to dip below the 1.1 lakh crore per month target, creating a shortfall. The government had to depend on the cess from the tobacco, fuel, and coal, raising the fears of the same outcome now. New tax rates and what's going to be changed. We will see that the new rates, the GST Council's rationalization plan will lower the tax on many goods, giving direct relief to the consumers. Big ticket items like home appliances, ACs, refrigerator, washing machine, large TVs, mobile phones will now fall under 18% GST instead of 28% if the rate is finalized. Automobiles, including small cars, two wheelers, below the threshold will also shift from 28% to 18%. That is a direct discount of 10% from the government side, making them vehicles cheaper. Everyday essential like packaged food, dairy product, pasta, noodles, personal care items such as a tooth powder will move to 5% bracket. Stationery, cool kits, affordable clothing under 1000, footwear, vaccines, and agricultural tools will also become more affordable. In short, the new rate cut are designed to make both big purchases like cars and appliances and everyday essential like food and school supplies lighter on the consumer's pocket. Now we will see how this will impact the consumer's pocket. Let's take two examples. The first one is small car that is petrol variant below 1200 cc with a base price of 6 lakh rupees costing 7.6 lakhs with a 28% GST included. We are ignoring the cess and other charges for the time being. Under the proposed 18% GST, the small car will cost around 7.08 lakhs. That is a direct saving of 10%. That is 60,000 on this purchase of small car. That is a good amount of saving for the consumers. Similarly, a split AC worth rupees 40K currently cost 51,200 with the 28% GST. Under the new rate, it will cost 47,200, leading to saving of 10%, that is 4K. Because of this rate reduction that is going to be announced by the government soon, in the last few weeks, the consumer inquiries for the high ticket items like cars, ACs, smartphones have slowed down sharply. Dealers and e commerce platforms are reporting that many buyers are postponing the purchases waiting for the GST Council's final notification on the rate cuts. Just like people hold off before a Flipkart Week Blend Day or Great Indian Festival Sale of Amazon, households today are holding back in anticipation that price will drop once the GST on appliances and the vehicles comes down from 28% to 18%. This trend is visible across showrooms, online retailers, and even the local electronic shops. Consumers don't want to pay today's higher price if a few weeks later the same product becomes thousands of rupees cheaper. While this is temporary pain for the retailers, it also signals strong pent up demand that could be unleashed once the government finally announces a reduced rate in the upcoming weeks. We can also see that this rate notification will not benefit only the consumers, but it is beneficial for the business points as well. The GST rate cut is said to benefit several key economic sectors like automobiles, including the cars and the two wheelers. Will see the tax fall from 28% to 18%, making vehicles more affordable. Consumer durables like ACs, refrigerators, washing machine, TVs, and even the mobile phones will also shift to 18%, giving relief to households. Everyday FMCG items like namkeen, chips, butter, cheese, noodles, ketchup drop to 5% from 12%, helping the companies, those in the FMCG sectors. Textiles and footwear under 1000 will become cheaper along with stationery school kits. Healthcare may also get a boost with a proposal to exempt the GST on the individual life and health insurance premiums. Now we can see that airfares are soaring ahead of the festive season, putting extra strain on the traveler's pocket. With the demand for the flights peaking during the Diwali and year-end holidays, the airlines have sharply increased the ticket prices in some routes, even doubling the compared to the last month. Limited capacity, strong festive demand, and higher fuel costs are all adding to the spike. For the families planning to holiday travel, the festive joy may come with a heavier price tag this year. Right now, buying an AC before the GST cut feels like paying the full price a week before the Amazon sale. Only the foolish are rushing in. In other words, the market is in wait and watch mode, and the GST Council's decision will act like a trigger for the shopping rush, similar to India's festive mega sales. In summary, GST rationalization promises lower tax, similar compliance, and relief for the consumers. But the challenges around the revenue and state finances remain. What do you think? Will this reform truly benefit the common man? Share your views in the comments. Thank you.